Hey everybody, welcome to our Trader User Group monthly recap for the month of February, and just kind of where are we, where we've been, and where do I think we may be going. Before we jump into everything, let me just go through simple disclosure. Trading securities can involve high risk and loss of any potential funds invested. Any investment information provided by our user group may not be appropriate for all investors, as provided without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any of the information techniques that we talk about in our user groups tended to be for educational purposes only, not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain is going to want you to do. Now, just a couple of really quick admin notes for our members. We have our session tomorrow night. I'm going to be talking about our new secret trader portfolio. I think you guys are going to really love that. It's going to be open to the public in a couple of months, but for now, it'll be for members only. Also, I am close to putting the content together for my book, so I'll give you guys more feedback on that shortly. So that's kind of where we're sitting right now on all of that information. Now, if we jump into the markets and just kind of look at where everything has been and where everything is going, let's start off with, just kind of a relative performance year to date. And we can see that, nothing's really up a lot. It's clear in this graph right here that the NASDAQ is leading the way. That's the red. They're the strongest performance. And I ran this at the close of business on Friday because I wanted to get through March 6th. Even though our session is for a recap for February, I wanted to get the latest action because it was pretty good little downward action. These were a little bit better than this before this past week, but you can see the NASDAQ, we're up a little over 4%. The Russell, just 1%. The S&P, only 0.6%. That's 60 basis points. And the Dow, we're almost flatlined for the year at 0.19%. So the NASDAQ is getting a pretty good little bump this year. It's had a nice little run. Also, I've been encouraging our members to look at the Russell and mid-cap, MDY, Mother David Yankee, because I do believe from a relative performance basis, the smaller cap technology, the Qs, and mid-cap MDY are going to outperform the Dow and the S&P, clearly through the first half of the year. And then also on a relative basis, I think Europe is going to outperform the U.S. Remember, from the U.S. perspective, we are winding down and have ended our quantitative easing, and now the big bets are being made, and money is being allocated or reallocated based on when the Feds are going to start raising their rates. And after the jobs data that came out on Friday, that improved the possibility that the Feds would move up the date. They would begin their interest rate rise, and their speculation that it'll be sometime in June. It used to be that the bulk of the speculation is still Q4 of this year, in September-October timeframe. But with the numbers that have been coming out over the past month, some futures traders and some market participants believe that the Feds can raise their rates sooner than then. So we're starting to see money moving around, and it's very evident in the U.S. dollar, and it's very evident in the bond market. Now, for our members, we had a great week, especially on Friday, because we've been short bonds, and bonds just really fell off the table. And a lot of members also have been trading TLT to the downside because, I've just been encouraging folks that I think that's going to be a good trade, and it just, it almost, bonds just, I was looking for a 4 handle on the bond market. Remember, in the futures market, it's $1,000 a point. We got down to 3 and 20 ticks. But not quite a 4, but it was close. So it was a good day, and it worked also as a good hedge for folks that also had some long positions out there as well. And the U.S. dollar was very strong, which put more downward pressure on commodity markets like gold. We've still got a global deflationary kind of environment going on, and we've also been short the euro, or FXE. And my target was hit this past Friday when we were down right around 1.08 and some change, right around that area there. So we've been playing the euro nicely, the dollar, and those, you could probably say if you want to go long the dollar, you can do it that way, or you can short the euro, one or the other, or you can play both, but you don't want to get too over allocated because they tend to go in opposite directions. So those have been they've worked out very nicely for us this past week. Also, I've been talking to our members about a possible pullback, and I'm going to show you guys the charts here in a little bit, just kind of see where we're sitting. And it kind of came down, the markets actually came down and almost touched, sat right on the 50 EMA for the E-mini futures. So this is kind of how we've been set up so far this year, and we're going to look at to where I think the markets can go over the next couple of weeks. But this is the relative performance of all the major indices here in the U.S. markets. One other point, and I'm going to show you the chart of it as well. For those of you that would like to trade some European equities or assets, and you can't because of your platform, there are ways to do that with ETFs. Now, there are a couple of new ETFs that I've also been encouraging our members to take a look at, which hedge the euro out. So, for example, if you want to go long Germany, because that's one of the strongest countries in Europe, and I believe on a relative basis that one's going to outperform all of them, including the U.S. on a relative basis. You could trade EWG, Echo Whiskey Golf, but another better way to trade it would be with a hedged ETF, which takes out the euro. A lot of people don't realize when you trade EWG, you're actually trading it in euros. So as the euro is going down and the German country index is going up, you've got some drag on your long position there. That drag is being held in euros. So we want to hedge that out. So I'll show you that here shortly as well. Now, if we look at one of the other things, let's look at the various sectors year to date and how they're performing. And as you can see, the markets are really in a situation where we're more risk off than we are risk on. I mean, you can see here, this one right here, which is healthcare. And nobody is really knocking the ball out of the park this year. But the healthcare sector, this would be XLV, right? It's at 3.83, and the winner so far year to date, only because it had such a strong February, is discretionary, or you could call it cyclicals, which would be XLY, right? Consumer cyclicals. That's things like big screen TVs, jet skis, snowmobiles, boats, other things that consumers tend to buy when they're feeling good. But this thing has come down a little bit more, but we're also seeing materials right here, which is kind of surprising, but and we've been talking about it in our sector rotation, which has done very well as well. And technology here, XLK. And when you think about it, through March 6th, right, these are the only sectors that are above water this year. Everything else is underwater. Everything. We look at industrials, XLI, right? They're under. Energy's had a really good comeback. Otherwise, it would have been a lot worse. XLE. Now, we jumped on energy in the beginning of February and did very well because it was oversold, and I could see a bounce coming. I'll show you the chart shortly, and you can see how it just really performed. Utilities, bringing up the rear. We had a great trade for our members on utilities. It is down year to date 8.71%. We shorted XLU when it was towards the peak in January and just rode it down. It was really nice. And then financials. Now, financials, XLF. Well, let's draw it in here. XLF. I think financials is going to be a surprise performer as we start going through the year. Why? Because it's driven by interest rates. as interest rates start to creep up, and they will, we know, we just don't know the timing of it, but the markets being a forward discounting mechanism, the minute they anticipate the Feds are going to be raising their rates, even if it's 90 days out, 120 days out, those markets, those sectors, those stocks that are interest rate sensitive to the positive side will start moving right up front. So by the time the Feds actually raise their interest rates, and you read it in the Rat Brain Journal of the Day, which is the National Enquirer, the Rat Brain Traders Journal, Business Journal of the Day, the National Enquirer, or the USA Today. About 60% of the move would have already happened in a near-term basis. So this is why we want to watch this sector rotation and get in a little bit earlier and capture more of that move. So I do believe XLF here is going to be an interesting play, even though it's underwater year to date. Utilities, I don't think that's going to be a performer. When interest rates start going up, that's just bad voodoo science to XLU. It's just not good. I think healthcare is going to continue to do very well. I think consumer cyclicals, which is the discretionary, is going to do well. I think energy, it's going to be tricky in playing energy right now. I'm going to show you the sector rotation graph here in a second, but we got to be careful on energy. Inventory levels are just going through the roof right now. So oil futures could end up tacking to the southern side. I had projected, the original projection we had that I was passing on to everybody was oil at $50 a barrel. And keep in mind, that was when oil was about $100 a barrel. So we started shorting some of that stuff, and we had a perfect setup for that. And the minute it broke and started running to the downside, that's what we were talking about. But XLE does not really follow oil futures. It's the energy sector ETF, but it's comprised of refiners, producers, service providers, wholesalers. So it's got a number of different energy stocks in there. Some of them are going to do quite well, even though oil may stay where it is or even go down a little bit. So XLE will be an interesting trade. Oil futures, I believe, is going to drift up or down and stay probably south of $60 a barrel for some time. So how are we trading that? We're trading that with credit spreads both north and south of the border on oil futures in the oil futures market. It's worked out very nicely for us. So that's kind of what I'm looking at right now across the sectors. And you can't see it, but right here, consumer staples, it's flatline, right? That's XLP right there. Now, generally, when risk is off, meaning there is nobody wants to take risk in the marketplace, what you typically find is XLP doing very well, right? Right now, it's flat year to date, down 0.04% or 4 basis points. XLV, we see very strong in a risk-off environment. And we see utilities very strong in a risk-off environment. And then when the markets start to turn and things start to go stronger, then we want to see some leadership out of you can't see that, but XLY, discretionary, we want to see leadership. We want to see leadership in XLK, technology, and we want to see leadership in XLF, all right? So when the markets start to turn, we want to see leadership in these guys. So right now in looking at this, and then energy is usually coming on strong as well, XLE. So net, when we look at this, we're getting a little bit of a hung jury on the markets right now. There's confusion in the markets. We got some leadership in XLY, none at all in XLP, but we don't see technology up in this area, which is where it should be. And we don't see some of the leadership in oil and energy. which shows a global growth story. Why are we getting this mixed message here? Because of the way over the past 5 years money has flown into the markets. We've got Japan, the U.S., and then Japan kicked off monetary stimulus with QE. U.S. first, then Japan. Tons of money in the markets. And if you remember the U.S., some of you are relatively new and been trading just for a short period of time. Money was forced into U.S. equity markets, so there is some fear of an asset bubble. I don't have that fear here in the U.S. Yes, we've got some fairly valued and some richly valued stocks, but I think we're probably fairly valued. In some markets, we're a little bit overvalued, like a biotech, a little bit overvalued in some of the technology, but otherwise, it's a fair valuation, which means stock pickers are going to do a little bit better in the U.S. markets. And then now we're starting to get, and then we started getting stimulus in Great Britain, over in Europe. And then all of a sudden, the ECB was having trouble across the 18 countries that make up the euro, and now they're starting stimulus to the tune of about 1.1 or 1.2 trillion every over the next 16 months or so through September of 2016, and it kicks off this month. So it's going to be real interesting when you've got all that money sloshing around and you got big money going from country to country to country, chasing sovereign bond yields, trying to get a higher yield on their money. That's what forces money, just like digging a ditch and forcing water into a dry crop. If you're a farmer, they're forcing money into the equity markets right now. We don't really care. As traders, at the end of the day, we could care less. We're agnostic. We just want to go where the money goes or where the water goes. That's all we want to do. So, but it does make some of the correlations, as you can see on this graph here, just a little bit tricky. All right. Some that should be down in this area here are up here, and some that are up in this area up here should be down here. So it makes it a little bit tricky. Okay, that's all I'm saying. When the markets start to stabilize and we start to get a more normal market, basically, and that's probably not going to be for another year or two, and then people are going to freak out because then the correlations are going to be all different, and you grew up if you just started trading over the past 5 years under the current market environment. Which is why on Friday we saw equities crash by 25 points, 27 points, over a couple of hundred points in the Dow, almost 300. Because the markets say, hey, they're getting ready. They crash not because the U.S. economy is doing so poorly. All right, keep this in mind. Not because the U.S. economy is doing so poorly. The U.S. economy, with all these numbers, are showing we're doing fairly well. We're growing not as fast as we would like, but we're expanding. But they fell because of the anticipation of an interest rate rise is going to be sooner rather than later. Okay, so that's why they fell. And the bond market also fell hard. Again, because of an anticipation of an interest rate rise, which is why the dollar took off to the moon. And we've been long the dollar. And the euro, of course, fell. And the euro, I think, is probably, if it breaks the 108 area, 1.08, we're going to hit parity in the euro, and the dollar is going to keep going up, which is going to continue to push gold down because it fell hard on Friday. It's going to continue to keep a downward pressure on other commodities because most of them are traded in U.S. dollars. Now, on the global stage, countries like China and some of the other countries in the Asia-Pacific area have done these currency swap agreements where they're now trading oil and others in non-U.S. dollar terms. So the dollar, the strength of the dollar is not going to have as strong as an impact on commodities, some of the big commodities like oil and some of the others, as it did before. But it will have some impact on them. Okay, so I wanted to spend just a little bit of time on that because I know a lot of people on the call today, and Jenny, I see we got our resident farmer in there. We got a couple of other farmers out there as well. You understand that sometimes a strong dollar can actually slow down and hurt growth in U.S. markets, because when you export in the S&P 500, over 50% of sales in the S&P 500, and it's over 55% in the Dow, are exported goods. And we're already starting to see some companies complain and moan about a stronger dollar. It's almost like an automatic price increase on their products as they try and sell them to other countries. So that's going to start to be reflected in the forward earnings projections. So we're going to get a better flavor on that in April when we start looking at Q1 earnings. Okay, so that's kind of where we're sitting right now. Now let's look at sector rotation. The nice thing about this chart, I think some of you have made, many of our members, I know I go through it all the time. Some of our members, some of the other folks that are on that are not members of our group may not understand this sector rotation. What it is it's a crosshair chart. Right in the center is the SPX. So this is a relative performance graph relative to the SPX. So if the SPX goes down and your security goes down, but not quite at the same vector, then it's going to show your security outperforming the SPX on a relative basis, even though it may be underwater. Okay, so, but again, we don't really care. All we care about is where is money going. That is our big thing. Where is money going? And over the past 90 days, you can see each circle on this graph represents 1 week in time in relation to performance of the SPX, okay, which is the cash index of the S&P 500. So you can see on a relative basis each week this thing starts moving. And the nice thing about it is a typical rotation graph goes like this. It goes clockwise like that. The best sector to be in is right here. You're leading the SPX. The next best one to be in, or the quadrant, would be right here. You're improving dramatically. And then right here it's showing your performance is weakening against the SPX. And then the worst quadrant to be in is right here. You're underperforming the SPX. The color of the tail represents which quadrant you're in, okay? Obviously, if it's blue, you're in the improving sector. If it's in green, you're in the outperforming sector. If you're in yellow, you're in the weakening. And if you're in red, you're way underperforming. Now, if we look at this, now keep in mind, each circle represents 1 week in time. So it's like looking at the difference in looking at a, let's say, a weekly chart versus the daily chart. Trends tend to hold much better on a weekly chart, right? But there's a bigger lag in this thing. But if we look at this chart, we can see very easily why we got into XLE. When it was down in this area down here, remember, oil was way down here. And when it started moving up, because keep in mind, things always move like this. Money moves in that fashion right there. When you got things down in this quadrant here, and once you get a movement up here, it's worth it to come in and just slowly start dipping your toe in the water and doing some investment, because generally they're going to move into this area here, and then the odds favor a move here, and then it's going to be out of fashion and out of favor again. So these sector rotation charts are great for us to look at, and they're also very visual, so it makes it easier for folks to pick these things out. So you can see here, obviously, energy and materials. Remember, I showed you on that year-to-date performance graph, energy was down below, but it is still starting to outperform on a relative basis, the SPX. And then consumer cyclicals right there, or discretionary, which is doing very well, which, you know, typically you wouldn't expect it to see here. Utilities is really starting to underperform. You can see utilities was way up here in January. It was doing very well. And as it started coming down, we started shorting utilities, and then it just fell off the table. Now, one thing we haven't talked about is the Dow Jones Transport Index. Typically, you guys know the old Dow theory of you want to see new highs in the Dow and the new highs in transports, Dow Transports, which is the old theory that the markets are very strong. Well, what we've been seeing over the past couple of months, transports have been underperforming. Some of that right here is the increase in energy and gas prices, right? We've seen gas increase about 10 or 15% just over the past 4 weeks at the pump. So we're seeing some relative underperformance rather. But the other thing that concerns me is financials down here. I do believe it's going to spook everybody and start to move back up again. So you heard it here first. Watch that and you'll see what I'm talking about. Once we start getting interest rates moving, I think we're going to see the financials start to perform again. So it could be one that we may want to keep an eye on. Now, let's go take a look at this chart on a daily basis. If we look at rotation on a daily basis, it tells a completely different story. You can see here utilities on a daily basis was way underperforming the SPX, and now it's up here. A lot of that was because risk is coming out of the markets. Remember, when risk comes out of the markets, utilities, money goes into utilities because they pay dividends, they're safe, and that's kind of where it goes. Healthcare up there is kind of a safe sector. Staples is a safe sector. So remember that chart I showed you was year to date, but this is over the past 2 weeks. We're getting discretionary coming out of the leading area. It's falling down. We got technology coming down. We got materials coming down. We got energy coming down. So those that we see starting to perform, these guys right here are those that tend to perform when we got risk coming out of the market, meaning money does not want to seek risk, it wants to seek safety. And it didn't just happen overnight. These guys started slowly drifting up. We looked at this right here. These were slowly moving up. XLV slowly moving up. These guys were slowly coming out of the leading sector. So you could see money very slowly or quickly, depending on your time frame, shifting from those higher risk investments into lower risk investments. And that coupled with the charting, I was telling our members, we got to watch out. We're going to have a pullback. And sure enough, that's what we got. Now, what you can't tell, I said a pullback. I said you can't tell how far the pullback's going to go or when exactly it's going to start to show itself in the E-mini futures. But that's what we got. And these charts really help you start to just, tell a story here. Does it make sense? Or is it just very confused and just noise? Right now, we've got more of a risk-off environment as we went into the end of the week. Now, if we look at commodities over the past 90 days, we also, here's gasoline and here's oil. When these guys were way down here in the corner, we were looking at trading gasoline to the upside. And oil, I think there's a limit on oil. We were trading that more on just credit spreads underneath the oil market and up above the oil market. Natural gas, you can see natural gas here. It started up here and it started coming down, and we just started shorting and playing natural gas to the downside. Okay, and then of course you got lean hogs and meat, live cattle, all of these, and then you've got corn, wheat, and these corn and wheat were also underperforming. And over the past 90 days, we are now getting out of gold and silver. You can see they've had a little bit of their run in January, and then they've just been slowly coming out of the market. So commodities is also a really great way to get a heads-up view of why this is going to be here. Yeah, I don't know if I can pronounce your last name correctly, Huang. This is going to be recorded and it's going to be put in our blog. So I highly recommend all of you that are non-members go out to our website, and I'll write it out here for you guys, and I apologize if it takes just a little bit of time. Trader User Group.com. All right, traderusergroup.com. Go in there and then click on our blog and register, or just register to our group. That's the best way to do it. Registration is free. Doesn't cost you a dime. I don't ask for a credit card, none of that crap. Go on and register, and then you'll get our weekly updates. There'll be some free videos for you out there, as well as being able to get to our blog. Now, I would encourage you to come on as a member, because then you'll get all this stuff, and we go through it 3 times a week, and it'll get you on the right side of the market, right? We're off to a great start this year. We had a great year last year and the year before. I've been running our group since 2008. September of 2008 was our first meeting, and we've done very well. And you know what the markets did, and starting in 2008, 2009, 2010. So they've done markets have been poor. We don't care. Again, I'm agnostic. I could care less what I'm long or I'm short. What I do care about is I want to follow the money, and that's what we do here. Now, let's look at the countries. You remember what I told you guys on a relative basis? The countries, especially over in Europe, are going to outperform the U.S. Russia was way down here, and it's just come up just because it's more of a dead cat bounce. We got Brazil, we got Latin American markets, we got Italy, we've got Germany, we've got emerging markets. All of these are in the blue. Notice there, and then we've got China over in this area here. And there's nothing in the red, and there's nothing in the yellow. So this just says these things are starting to tee off as we go into 2015, okay? They're starting to tee off. And we want to play. Now, if for those of you that use Interactive Brokers, you can go out and you can actually trade German stocks. You can trade British stocks. You can trade Spanish banks and Italian banks. Spanish banks are good to trade. They really were oversold. They just got tanked, and now they're starting to perform again. Why? Because there's going to be a lot of guys. It's real easy to think about. We had a lot of money coming into the U.S. market starting in 2008, 2009. Quantitative easing. You saw what the equity markets did. Well, markets are markets, whether they're European markets or U.S. markets. So you're going to see the same thing happen with European equities. Okay, so we want to play it, but if you can't play actual securities over there, you can trade the country securities, and I'll show you those in a minute. But this is what's going on from a country standpoint. They're all, and you can see again the SPX on a relative basis is right here. So all of these are starting to, they're improving, and they're going to start. A lot of these, I guarantee you, and I hate to make guarantees in the market. There's no guarantees, but the odds highly favor them just continuing this clockwise rotation, and they're going to come into the leading sector here, which means they're leading the SPX. Remember what I said. If the SPX goes down, these could go down as well, but on a relative basis, they're going to outperform the SPX, and all we care about is that. Big money, that's all it cares about. Most of the guys that are running big hedge funds, big mutual funds and everything else, you know how they're paid? They're paid on a relative basis, right? So they could do crappy for the year, but as long as they outperform the SPX, they're going to get their bonuses. And again, we don't really care. We just want to go where the money goes, okay? So this is countries. Transports. You remember what I told you about transports? Over the past 2 weeks, they're starting to improve a little bit. And you can see here Delta Airlines, United Airlines, Alaskan Airlines, Southwest Airlines. The airlines tend to go in a grouping as they rotate relative to the SPX. J.B. Hunt. You can see Lone Star. You can see the trucking companies. They tend to move in a group as well. And then we got UPS and FedEx, right? But we can see here the airlines are starting to come back just a little bit. So, you know, and Kansas City Southern, it's almost like when we see airlines outperform, we see the railways start to underperform. Now, we've had some railway, say that fast 10 times, railway train crashes involving oil. So that tends, as you'll see, it tends to take these and move them down. But I do like J.B. Hunt, Conway, and some of the big some of the big trucking companies and rail. I mean, I do like those, right? So those, I think, would be good as we start to continue to improve in the markets. But and if we look at industrials, really, from an industrial standpoint, you know, we've stayed away from many of them. The industrials have had a really poor year. GE is about the only one, and then maybe UPS and 3M. But just about everybody else is underperforming in the industrials. So if you're in, and the industrials, by the way, is XLI. And you remember when I showed you the graph, XLI was having a poor start to the year. So most of them are underperforming. But UPS, GE, and 3M are the only ones in the industrial sector. Now, if we start to get more of a global growth story, you will see XLI start to perform again. But right now, I'm not doing anything in the industrials. If you do, it ought to be in either GE, 3M, or UPS. And in fact, I would probably favor 3M and UPS over GE at the moment. Okay. Now, if we look at energy, well, sure enough, over the past 2 weeks, energy hasn't done very well. Almost now. Fast forward backwards in time 2 weeks. Almost all the energy, it looked like that. They were all right here because that's where these guys started. So almost all of energy was sitting up here. And then just in a 2-week period, you can see the money being sucked out of energy, being sucked out of all of these energy stocks. I mean, they just in tandem, they started outperforming the SPX. Money has come out. But then what's going to happen? Typically, you get all of these as a grouping. Once the market stabilizes, they're going to all start moving back again. And this doesn't just happen in one day. It happens over a period of time. So we use these charts to help us just kind of look at where do we see the next sector starting to improve. And then we either can play the sector ETF or we can play some of the stocks within the sector. Because you remember I showed you this on the ETF. Now this is XLE, okay? This is not oil futures. So you can see Exxon, SLB, Schlumberger, Apache, Phillips 66 right down here, Rig down here, National Oil right there. You can see them. They're just, or Halliburton down here. They're all grouped. Money, it's when big money, you know what they do, guys, and you guys probably just intuitively know this. Big money's not going to say, well, I'm just going to get out of one stock. They may have an allocation of, let's say, 15% of their portfolio to energy or 10%. They say, well, we're over allocated. We're allocated 15%. We see energy getting weaker, so let's take 5% out. So of that 5%, which may represent $1 billion, it's spread out among, you know, maybe 4, 5, or 6, or 7, or a half a dozen stocks. They just slowly start selling over a 2-week period. And this is what you get right here. All right. It's not like someone woke up and said, well, I'm going to sell Exxon. I'm going to sell Apache. I'm going to sell Schlumberger. I'm going to sell Halliburton or Hess. You know, they have these automated routines, but what we don't care about that, guys. All we care about is once that selling starts up here and we see it going, then we short XLE. And we just know once it starts, it takes a few weeks or 3 or 4 weeks to take effect, right? Now, we did that with XLE, but only to the upside, and we had a pretty good trade. So that's how we follow some of this stuff, and it worked out really nicely, I think. There's still, you will always have the anomaly like NOV, right? And then some that way underperform like RIG compared to the grouping in the center here. Discretionary has done very well, which again, you would think in a risk-off environment, it typically does not. But you can see Nike has moved into the leading area. Now, Priceline was up here. When Priceline it started moving up, that was the signal. And what did Priceline do? It's done very well. Expedia. Priceline, these guys right here kind of go in tandem. You can almost see them moving at the same time. Expedia, it started going down, and then all of a sudden after a couple of weeks, or I mean about 5 days, Priceline started going down, right? And then you can see down here Best Buy, Starbucks, Lennar, Amazon, Netflix, Pulte Homes, the real estate groups down in this area here, just really underperforming. And then CMG, our favorite Mexican grill company here. So, but what we want to see, these are pointing in the wrong direction. That means, in Coach right here, money's starting to move out of them and maybe into some of those risk-off environments like utilities and staples and some of these others, right? So that just means next week we have to be very careful, right? Now this doesn't, as I said, it didn't just happen overnight, and we could see this thing coming. Financials, look at financials. You remember that was underperforming. Year-to-date, financials is underwater. You can see all the financials, almost all of them in the green, but they're all heading in the down direction. And you can see a number of them down here, and you can see those financials that seem to be doing better than others, right? And some of them are more insurance-oriented, Metropolitan Life, Prudential, right? Zions Bank, which is a regional bank, Citi, right there. AIG, more insurance-oriented. So we've got mostly here insurance companies, which are the safer bet within the financials, leading the way. And then we got Goldman Sachs, BBT, Capital One, Wells Fargo, WFC, Bank of America, KeyBank, all these guys. The banking side of the financials are underperforming. The insurance side is up here, but again, they're going in the wrong direction. The only one that's really made kind of a surprising rebound is American Express, which was so underwater, and then they've just kind of bounced back. But this does say that, you know, this bloodletting may continue for a little bit before they all get down here. Now, all the banks down here will probably move over here a little bit before you start to see money coming back in again. Yeah, Chris, you can get these you can look at the video and you can record this over, and then, you know, when I'll reach out to you because I know we were going to do some one-on-one. I'll talk to you about how to set these up yourself. Okay, so they're pretty easy to do. Okay, so that is the financials. Technology, again, a very mixed bag. Most of them pointing towards the down direction, but you can see technology was up, but not much for the year. Yahoo was outperforming, Microsoft, Google, eBay, CRM, which has done very well, right? I've been a lover of CRM, and then you can see most of the others underperforming here. Materials, again, way underperform. The one that I like, guys, and it just always seems to be near and dear to the SPX, is Sherwin-Williams. I do believe Sherwin-Williams, you know, it's painting, but they do very well. And they're just always performing near the SPX to slightly better than the SPX generally. It's usually right in this area here, which means it outperforms the SPX, because remember the SPX is at the crosshairs here. It outperforms the SPX just a little bit, and it's a good stock. And generally when the markets crash, it doesn't crash too badly, okay? So I like that one in the materials. CLF, Cliff Natural, you know, that one is also a little bit more speculative. In CF Industries right there, those have for a long time been underperforming, and then they just moved up and started performing well. And then U.S. Steel. We've had a lot of fun with U.S. Steel over the past 6 months. We've been bullish big time on U.S. Steel, and we've been bearish big time on U.S. Steel. Just watching U.S. Steel just make its routine, right? It's a good one, and it's heavily traded. So that's a little bit about the material sector. If we come over and we look at healthcare, now healthcare has been doing very well lately. Humana, UNH, United Healthcare, AMGN. I do not have on here biotech. I do have BIIB. and Gilead right there, ABBV, Johnson & Johnson, Merck. All of these guys, I like healthcare, XLV, or you could come in and add a little bit more oomph to your portfolio by picking some of these right here, okay? Now, there are other healthcare stocks, but typically what I select on this comparison graph are those that are the biggest holdings of XLV or each of the ETFs, right? So that's what I wanted to pick, just to give you guys an idea of how to run that one. Consumer staples. Well, again, when risk is off, meaning people don't want to take risk, Monster Beverage, Walgreens, we've traded these guys, Colgate-Palmolive, Altria. These guys are very good. Coca-Cola, Procter & Gamble, Walmart, Kraft Foods, Archer Daniels. The big guys, the ones that, as you can see, are just well over here and really outperforming the SPX on a relative basis, right? So, and if you don't want to pick individual stocks like Coke or Pepsi, which I think will be good on a global stage, because as the global economy starts to come back, as they start pumping money in, you'll see those guys start to perform better, right? But this is XLP. So if you don't want to trade and be a stock picker, you can just trade XLP, right? Now, when the markets start to come back, XLP will go back down, and XLY, which is surprisingly strong right now, will probably get even stronger, okay? So that's a little bit about these guys right here. Now, if we look at utilities, you remember what I showed you? Over the past 2 weeks, again, this is a 2-week movement graph. Each of these circles represents 1 day in time in relation to the SPX. And you can see almost in tandem, it's like money just knew to go into utilities, right? Almost all of them. We don't even have the other side of the graph here. We don't have the leading part of the graph because nobody is in the leading, or we don't even have the weakening side of the graph because no one is weakening. They're either red or they're blue. And almost all of the utilities that make up XLU over the past 2 weeks have been starting to improve on a relative basis to the SPX. What does that mean? That means money is slowly being sucked out of risky investments and put into safer investments. So as an investor, that means if we've got a lot of long positions in stock, we got to either start thinking about hedging, or we got to start thinking about buying some puts. Now, in our group, I started calling this out back around the 23rd of February, about 2 or 3 weeks ago, when we see these things starting to make these moves, all right? And that's the way you got to kind of play this market. All right, so now what I want to do is spend a few minutes going through some key charts here. So let me just freeze my screen here, and let me just move back up. And again, this will be recorded for you so that you can go in and look at it at any time. Get a pencil and paper and write down stuff if you need to, but it's going to be recorded. So let me just move over to the charts here. Let me get the screen back up, and as always, we will start with the E-mini S&P 500 futures first, okay? Now, this is the futures right here. And what we see here on this chart, obviously we know we've had some pullback. But right in this area here, I was telling people we need to be careful because the odds favor. We had a lot of pressure on the markets right here, pushing them down. And I said that we're probably going to get a pullback. I did not know how far down that pullback would go, right? I have no idea. And I did not know at what point it would actually start. But I said, let's start putting credit spreads up above the market. That would be a safe play, or taking on some puts would be a safe play. Now, one thing I did, which was a mistake, I put on some volatility trades in UVXY. All right, and I got out a little bit premature after we had a little bit of a pullback here. UVXY tends to go up. just like volatility. It follows volatility, but is an ultra short. So it's like it moves faster than volatility does, VIX. And when we got that first pullback right here, volatility didn't move. The markets were just not concerned. And so UVX was starting to go down, so I just shut the position down. Now, I had other positions on in case we fell. It was just more of a trade where I just wanted to play it. And then sure enough, as soon as I shut that down, we had that big move down there. Big move, and then UVX just went through the roof. So I just didn't hold the position long enough. But I've still got some other trades that are working very nicely because we anticipated this pullback. Again, the degree of pullback, you couldn't tell. You can see that red line there. That's the 50 EMA we're sitting on. We actually came down and we touched it. You can see this red line here. That is the high for 2015. I highly recommend you take your charts and you mark the high and the opening price of 2015, which is 2055, and the low price for 2015. Mark these on your chart because price action, when you get near the highs, the opening, or the lows for the year, the markets are looking to make news, and they will just magically find these areas, which I said if we break this upsloping trend line here in this support zone right here, we're going to test the 50 EMA, which is what we did. And the odds favor is to come down and test this 2055 area, which was the opening price of the E-mini futures for this year. Should that break, I think there's really nothing but dry powder here for us to move down and test the 200 EMA, which is just above another strong support zone, as you can see right here. Now, are we going to come down and test that? Well, we got to take it a bar at a time, but I do believe if we break the 50, we're going to come down and test 2055 very quickly, just because that's the opening price for the year. Now, for those of you that follow me with charts, you know one of the things I love to do in going from the daily chart, I like to go into a 2-hour chart, which is kind of like X-ray vision into what the daily chart is doing. And you can see here, you know, we gave it up starting at early in the morning on Friday, and we just never looked back. I mean, we just started moving down. We blew through our support zone, and this is where we went right here. I mean, it was an ugly move, a very ugly move. Now, typically what happens like this, and you don't want to get suckered, what can happen is we just measure the depth of this move. You can see right there, if I draw this line right here, and it shows up on the 2-hour chart, you can't see it on the daily. You can see how it served pretty much as support and then resistance after we went below it. So I would use this area right here, which is around 2014, right? And then the low for Friday, which is around 2064, roughly, okay? And then I would say, okay, if we plot these guys right here, 2064, and I'm sorry, this would be 2114, right? 21, let me just see here. Let me get the actual reading because this is crazy. Let me just get the actual reading on here for you guys. We'll put the actual reading right on that guy right there. So let's just do it like this, right? Like that. So 2105. I don't know how I got that. And then let's go down to the low right there like that. So basically we've got 2065 and 2105. So if I take 2105 and I subtract 2065, you know, that gives us a range of about 40 handles, all right? So from there to there is roughly 40 handles in the ES, in the futures market. Typically, when you have a move from one resistance point to the low of that right there, you're going to have a retrace of 50% or about 40 handles right there. So if you just take 20 handles and you add it to the 2065, that gives us 2085 right in this area right there. So 2085. So come Monday or Tuesday, I would look at that 2080 roughly the 2085 area, because we can get a movement up to that area, right, which is, if you'll notice, is also another resistance point right there. And then watch what happens. We could get a rollover. This thing here will suck people in, and then it starts to roll over. We take that low out, and then boom, we come down and test the 2055 area, which is the opening price of 2015. That's what we want to watch. Now, if you don't want to do the math and you want to use your Fibonacci's, that's another good way to do it. I could come in here like that and hit the high. Well, let's just do it like that. I can come in here and hit the Fibonacci. Let me just see if I got a couple of different choices here. And I can do the low, the high. Well, I gotta turn it on is what I gotta do. Like this. And put it on here like that. All right, and then I'll blow it up so you guys can see it right like that. So you can use the Fibonacci extensions off the low, and I didn't hit it exactly to the point, but this is saying 2084.85, and I said 2085, so that's close enough. That's the 50 percentile extension off the low. So I would have this on my chart for tomorrow, for those of you that are going to be more active trading. Because what can happen, we got a three-leg Elliott three-leg down, and what typically happens after a big move like that, it suckers people in, and we move up to the 50 percentile level or the 38 percentile level, and then, you know, one of these movements right here, and then boom, it just encounters hard resistance, and then it starts the trek back down again. And then it may just kind of head fake you and then go back down like that, and then you start off on one of these kind of channels back down again, okay? So that is what we're going to be watching for on Monday and Tuesday. This is a 2-hour chart. It really will help you determine direction. And this is another way to say, am I a buy on the dip or a sell on the rally? We use the 2-hour chart to say I'm buying on the dip or selling on the rally. I'm sure all of you have heard the term, right? Buy on the dip. Well, if it starts moving up here, if you're day trading, you've got to watch for resistance at each one of these points as it starts to move back up. And if it starts to counter, if you just take a long position right here, you want to try and catch a falling knife, and it starts moving up. As you get into each one of these levels here, you're going to move your stop tighter and tighter. If it starts to roll over, you'll probably see more people jump in shorts, meaning I'm selling any kind of rally off of this big down move. I'm going to be a seller of a rally. And the momentum is down. The daily chart is down. So right now we're a sell on the rally until we're proven otherwise. And what would tell us we're proven otherwise? Well, what will happen is on a 2-hour chart, you're going to get a situation where we move up, we form a pivot high on a 2-hour chart. We move back, we form a pivot low, and we do not take out that prior pivot low. Then we start to move up, we form another pivot high here, and we're at another Fibonacci level. We pull back, we form another pivot there, and we start moving there. Then slowly, we shift into a buy on a dip mode, and then we want to be buyers on these pivots as it moves back up. Now, this is strictly for those of you that are short-term traders. For those of you that are position trading and you're holding something a little bit longer term, we can go into the 2-hour to say, well, do I need to add more to my hedge? Because the minute, this is a key pivot right now, the low that was made on Friday at 2065.50 on the E-minis. That, folks, is a key pivot. If we take this key pivot out, we're going to go a lot lower. And we may come down and then come back and test that pivot and then roll back again. So we got to be very careful. But these 2-hour charts will help us make these determinations. So that's how you can use your Fibonacci to help you kind of ascertain exactly where we're going to go. Now, this is the E-minis. But if we go back to the daily, you'll see here that we've got a cross in our exponential moving averages. We got a movement down here. I started calling this one once it started moving up. The minute we took out that pivot high right there, right in that area there, I said we could be setting up for some downward action. So we were looking at, and I was adding some call credit spreads north of the price because the odds favored us pulling back. And I said the first touch point is probably going to be this zone here. If we break it, we're going to stop at the 50 EMA, which is what we did right now. Okay? So again, this is where we're setting on the E-minis. If we look down here at the bond market, you can see in the bond market, boy, did it get hit hard. Now, I know a lot of you may not trade the futures. It can be confusing to some. Why? Because you can see there was a price here, and then all of a sudden the price moved up here. Boom, like that. This price down here was right around 148 in the bond market. And then up here, this price was 162 in the bond market. Well, all that was a future roll out to June from the March futures contract. It expired, and then boom, we moved out to the June contract. June, there was huge contango from one futures contract month to the next. And when you're in a contango environment, the odds favor a downward pressure on the market. So we got normal downward pressure, plus we've got an anticipation of an increase in rates, which tends to move bonds down. So I think bonds are going to continue down. Now, if you can't trade the bond market, the other natural trade would be TLT because it goes in the direction of bonds. And if we look at TLT, you will not see a gap in the stock, right? It just started going down, and we've been short TLT as well. When TLT came down, hit this area here, I was telling our members we got to watch for a little bit of a contra rally. We blew through the 50 EMA, went a little bit higher than I thought, but boy, once it started rolling over again, that was another sell point for those that can't trade bonds but want to trade TLT to the downside. We sat here for 3 days, and then boom, it broke. Now we're sitting just above the 200 EMA, which is right in the bottom of this upsloping channel here. We got a cross in the MACD below the 0 line, so that again is more bearish. I would not be surprised to see a little contra move back up, test that resistance area. That blue line is the opening price, 126.29 for the year for TLT. I would not be surprised to see a movement up and then a roll back down, test that there, and then away we go. And this is big money in the bond market, and you're going to see a lot more people jumping into shorts on TLT. Now, when you hear the term crowded trade, what does that mean? That means everybody's going in the same direction, meaning everybody is trading TLT to the downside. So what happens when that happens? Well, when you get a contra move like this, everybody that's short TLT, their stops or buy stops, so you have to buy it to get out of it. So what happens is contra moves tend to be very violent and very strong because all these buy stops are being taken out. So you get these huge contra moves which takes out all the stops. And then once all the stops are taken out, there's no more buyers left because no one wants to buy this thing. They want to short it. Then it starts rolling over again, which is a great point that you want to jump in and be a seller of those rallies. So we're in the sell the rally mode. If you're already in it, good for you, stay in it. You probably got a buy stop to get out of it. You want to protect profits like all traders. So if it starts to rally up right here, you'll take your profits, and it'll be a sharp rally because buy stops are being triggered, yours included. And then once it probably starts to run out of gas in this area and starts to roll, you just happily put your shorts on again, knowing that it'll probably come down, test that area, and start going lower. So that's how you trade these. Most retail rat brain traders, what happens is, and there's probably a lot on this call here, same thing, and your timing is off. Stock moves up, you go, boy, it's moving up, and you buy right here. And then you have a counter trend move right here. and it moves down. You're like, son of a bitch, you sell at a loss. And then a couple of weeks later, you see it's starting to move back up again, and you go, son of a bitch, I'm going to buy right here. And then it moves back down. You go, I'm at a loss. And that is the life of a rat brain trader. It's in a nice channel moving up, but your timing of your buying and your selling are completely opposite. It's a simple matter to change from a buyer up here to a buyer down here, and that is like learning how to buy. You want to know whether you're a buy on a dip or a sell on a rally kind of trader. You know, if you join our group, we go through this in a lot more detail, but I'm just kind of pointing this out on this free monthly recap session here for you. Now, currencies, U.S. dollar. We watched the U.S. dollar right here. When it started moving out on March 4th, that was the signal to go long, and it just took off, right? We've been long the dollar, in and out of the dollar, and then when it stayed in this range here, currencies will move and then stay in a range. That's just how currencies move, right? Currencies will move, and they'll stay in a range. And then once they break that range, they go to new ranges. And that's just the way they move. So you can see the U.S. dollar here. Now, how high can the dollar go? This purple line is a 50% Fibonacci extension off the lows made back in, a decade ago. Let's step out to a weekly chart just to give you guys perspective on just where the dollar can go. Look at this, guys. This gives you the peak of the dollar back in 2001, right after the dot-com bubble. The low of the dollar back in 2008, just before the markets imploded, or as the markets were imploding, rather. And now the Fibonacci off the lows, we hit, and you can barely see it. But you can see my shaded zone right there. Doesn't surprise me. We got stuck at that Fibonacci, and then boom, we broke up right here. Again, this is a weekly chart. Next stop, 102.45 for the dollar. Now, we may chop around, but that's where we're going to go. As they start raising interest rates, that's where the U.S. dollar is going to go. We have no bearish divergence at all on this chart. Can the dollar go higher? Hell yeah, it can go higher. So that's kind of where we're looking right now at the U.S. dollar. And we've been playing it to the upside. So for those of you that have been following me, your members, you've been doing very well in the dollar. Now, if we zoom back out again, go back to the daily, take it back into a short term, you can see that zone there, how we just sat, and then all of a sudden we broke out. Now, if we look at the euro, it's just the opposite. Look at these support and resistance zones for the euro. It did just the opposite. It broke out and it hit my target right in the middle there where the color on that bar changes from teal to, I don't know what that color is, purple maybe. Let's move it out to a weekly so you guys can see it a little bit better. That's the trade. We took this euro way back up here. We took the euro to the downside. And you can see where the euro, just like the dollar, it hits these points, and then when it breaks out of them, it goes for a run. And you don't know how long it's going to go for a run. Well, right here, I plotted the target of the euro at right around 108.5, 109, right in that area there. And we hit it. Now, if we blow through it, we're going to hit parity down here at 1. And if the dollar gets stronger, we're going to hit parity. There is absolutely zero on this chart. There is absolutely zero bullish divergence. So we are a seller on any rally in the euro. We're a seller, period, end of story. And they're just now starting to kick off quantitative easing. What do you think that's going to do to the euro? It's going to keep interest rates low, and it's going to just weaken further the euro. Now, a lot of the down move has already occurred. We made a lot of our money way back here. We made a lot of our money when the euro started moving down, right? Because the currency doesn't, and remember, the currency doesn't start moving down when they announce everything. Look at, the euro had already started moving down well in advance, And we were anticipating that, and that's the way we traded. Or FXE, that's the other way to trade it. The Japanese yen Same thing. You can see I mark them off. It stays in these consolidated zones. When it breaks the zone, away we go, right? We're now at the bottom of this zone in the end, but we've got bullish divergence here. So this tells me the end, the downside is limited. The upside can be a little bit more. Now, again, we traded the end to the downside way back here. When Shinzo Abe was elected Prime Minister of Japan, he ran on a ticket of printing more money, more money, more money, more money. Just like what we did in the U.S. It was like so well telegraphed. We started shorting that thing, and we did well with the Japanese yen, or FXY. So there's great money to be made in these if you just have a little bit of an awareness of what's going on in the market. Okay, or you can follow us here at our user group, and then you can do the same thing. Gold fell 28 points on Friday. Why? There's no inflation, guys. The dollar, strong dollar. We came down here. Now, I will say we traded gold to the upside right there. We made that trade in January. I said in January, gold is going to surprise everybody and take off. I didn't know my timing would be that good, but we rode that to the upside, and then we got out, and we haven't looked back since. I didn't trade it to the downside, but that's the way we're going. Any rally in the gold should be sold at this point in time. I think we're going to come back and test that key pivot there, and we could go even lower with gold. Same thing with silver. I think it's going to be weak. I think longer term, 2 or 3 years out, I'm sticking to my forecast on silver. Here's silver right here. I think longer term forecast silver is going to be back over 20 again, but it's just going to take a while to do. If you want to invest in SLV, it's a cheaper stock. It's not going to go to zero like a stock. Silver's not going to go to zero. But in these levels here, I would not mind just picking up a few shares of SLV. Longer term, when I say longer term, I'm talking a year or two. I think, a 20 or 30% bump to the upside makes sense. But because it's down low here and down in this area down here, you can see we're kind of sitting at a kind of a support zone like that. And then there's another natural support zone with silver at 1437. So, you don't want to go all in here. Maybe just pick up a few shares. It may go a little bit lower, pick up another few. But I think longer term, silver is going to start working its way back up. Probably better so than gold because silver is also an industrial metal. They do tend to be correlated, not perfectly, but I think silver will probably show its head again a little bit later on. But at these levels, it's hard to resist. Oil, well, oil went down almost $1 a barrel. You can see where oil is right now. We've been trading oil to the downside. I'm basically in the futures market in oil here with a short call and a long call above the market, and I'm way down here with a short put, rather, and a long put below the market. So I've just been trading this chop and collecting premium income. And that's all I've been doing with oil right now. I do favor oil to go back down a little bit lower. I think oil, I've got a target of oil right around 40, but until or unless we break that zone, it's not going to happen. So really, depending on whether we break the zone to the downside or the upside is going to be kind of how I play my trade. If we break it to the upside, we're going to move up a little bit higher. But you can also see, let me just zoom in a little bit on this chart. It's a daily chart, right? Let's just zoom in a little bit. You'll be able to see the 50 EMA has just been a bitch for oil to take out. There's the 50 EMA, and it's got a downward vector on it. And every time we get near it, we just bounce and we just go back down lower, right? That's all we're doing. And we've been in this tighter range here for a little bit. But if we break that range, we're going to come down and test that low there right around 43. And then I think the markets won't be able to help themselves. The momentum will carry us down to 40, maybe even sub 40. So until we break that range there, I'm trading at range bound. But I do anticipate a little bit lower price in oil. That's a little bit about what I'm seeing there. Gasoline, the charts look just the opposite. Look at gas, man. This thing's been moving up. That's why we've been more bullish gas. You remember the sector rotation chart? Showed gas moving up a little bit. We're just in a little bit of a pullback here. The only thing that concerns me about gas, we're in the seasonality for gasoline to move higher as well. So we got a lot of tailwind behind us. But we've got this confounding 3, 4, and then a potential 5 leg with an Elliott wave, which said this thing is due to go back down further. So I'm going to watch this here. This little bump right here was a change in contract month. That's all it was. But if we take out 178, I think we're going to go a lot lower. If we can gather some steam here and then start to move higher, I'll jump back into some long positions in gasoline. All right, so gasoline chart looks a little bit different than the oil chart does, which doesn't surprise me. We're starting to come into the seasonality for higher gas. Natural gas, I've been short this guy. We cannot get off the bottoms here. Even though we got bullish divergence, I think any move up right here is going to be met by the 50 EMA, and it's going to shove us back down again, right? There's the 50 EMA. It just shoves us back down. Right here, it was just the opposite. It provided support until we broke it right there, and we haven't been able to climb the 50 EMA again. So I've just been trading this with credit spreads up above the market, just taking profits and letting it sit where it sits, all right? Even though we got bullish divergence here, which would suggest we'll move up, and if we take out the 50 EMA, we may have a quick spike up, running stops for those just playing shorts. In the futures market, because it's a heavily crowded trade, just because seasonality said it's going to run back down. But that's what I think worst case it'll happen. I'm way up in this area, so I'm okay right now on this trade. All right, so let me just show you guys one other thing, and then I'm going to end the session here on the countries, because we had talked about the countries. Germany. Here's Germany right here. That's just Japan, sorry. Let's go to, where did it go? It disappeared on me. Here we go. Here's Germany right here. You can see Germany. Germany's going to be a strong one. We had a little bit of a pullback today. Any pullbacks, we are buyers on dips in the European markets. This had a little bit of trouble clearing this area here. If you buy EWG, it's the iShares Germany ETF, you're buying it with the euro factored in. So part of this downward move is based on the euro. And as you look at the chart, you got a little bit of bearish divergence, so that does suggest we can come down. And it looks like the 50 is about ready to cross the 200, which would be a very bullish sign longer term, right? So that's one way to play Germany. A better way to play Germany is let's hedge the euro out of the trade. Let's use DXGE. There's the same graph, but look at how much more escape velocity we've gotten of that resistance. And look at what happened here. We didn't fall nearly as far. Why? Because we're not trading Germany in euros. We're trading them in more dollars. And so we're getting a little bit of a double-edged sword here. Okay, the euro is going to stay weak, so DXGE would be a better way to trade this. Now, it's a relatively new security. If I zoom out, you can see here they actually started trading the end of 2013, so it's less than about a year or so of trading, maybe a little bit more than a year, but that's about it. So liquidity is not as strong. But I do like it better, and it's a cheap stock, so it's at 30.47. So if you want to play a European move over the next couple of years, maybe just picking up some shares of this, right? DXGE. If you just want to play Europe in general, hedging out the euro, all right, a way to do that is HEDG. Again, you can see how we kind of stuck out here, and then boom, we're moving up. HEDG, it's the European hedged equity. Hedged meaning we hedged the euro out. Now, this is a little bit more expensive than the German one. It's $65 a share. Again, this one's relatively new as well. This one, actually, it's been out a little bit longer in time. It started in 2009, so you're probably, that's why it's a little bit higher up. It may have a little bit more liquidity in it, but I do like these hedged instruments in play in Europe on a relative basis to the S&P 500. All right, guys, that is pretty much our session for today. There's a lot of other things. Members, I will see you guys Sunday night. Again, traderusergroup.com is where you want to go. Sign up. Registration is free. If you want to join our group, just find our membership options button. We got a lot of cool things going on. We're also in the middle. I would highly encourage you. We've got a trade adjustment and position management webinar going. We're on part 3. It's going to probably be about a 7 or an 8-part series. You can access those you didn't see in the recording. You can see those very inexpensive for non-members. For our members, it's free. So you can come in and access that as well if you're a member. All right, everybody, have a really great weekend. Members, I will get a meeting invite out to you. I'll see you Sunday night. We're going to go through our Secret Trader portfolio stuff, which is getting ready to kick off very soon. I think you guys will like it. All right, everybody, have a great weekend. Talk to you guys later. Bye now.